It's the special edition of Business Incorporated. Thank you for joining us. I'm Chimeze Obi-Iwago. Well, the Monetary Policy Committee of the Central Bank of Nigeria has been meeting since Monday to provide forward guidance on the timing of a change in monetary policy stance. The meeting is the fourth one this year and coming at a time of fascinating developments in the domestic and external economy. On the domestic front, headline inflation decelerated for the third consecutive month in June, despite heightened security challenges in food-producing states. On the external front, despite the sustained administration of COVID-19 vaccines and sizable fiscal and monetary stimulus, the spread of Delta variant in advanced economies has softened optimism on reflation trade. At the last MPC meeting in May, members voted to retain all monetary policy parameters with the MPR at 11.5%. The meeting ends today, and the Central Bank Governor, Godwin Emefiele, will be briefing on the outcome in about an hour from now. But first, let's look at the intraday market numbers. And here in Africa, the market here in Nigeria is still in the green, marginally up ahead of the MPC decisions. The JSE index in South Africa was the only laggard at intraday, down 1.13%. Elsewhere, the EGX 30 in Egypt was up 0. And the Nairobi Stock Exchange closed Monday's trading in the green, up 0.26%. In Europe, markets fell this morning as investors continued to monitor corporate earnings along with extreme weather and the spread of COVID-19 across the continent. Let's get a quick insight into what's happening in Europe today. Let's talk to Chelsea. Hello, Chelsea. Good afternoon. Well, Monday saw wildfires rage in regions across southern Europe as hot weather and powerful winds took hold. Also, the north of the continent continued a cleanup operation after days of torrential rain and flooding. Also, earnings continue to hold a spotlight for investors. Can you bunch all of these together for us and tell us how these are shaping investor sentiment in today's trading?
There's certainly a lot going on. The DAX here in Frankfurt started out with a pretty big slide. As you can see behind me, it started down over 1%. It has managed to climb back up and now is down only about half a percentage point. But there are a lot of fears circling markets right now. One, of course, is what's been happening in China over the past couple of days. China has really started to crack down on some of its big tech giants as well as the for-profit education sector. That is causing a lot of global investors here in Europe as well in the US to reevaluate their investments in these big Chinese companies that have been so profitable in recent years. As well, investors here in Europe are going to be watching very closely as the Federal Reserve is expected to release its next policy decision tomorrow. And after markets close in the US today, we're going to get some really big, important tech earnings. So everything from Alphabet to Microsoft to Apple, they're going to be posting their results today. And of course, those are American companies, but they tend to really swing markets all over the world. So right now, there's a lot that investors are focusing on, including the rise of infections of COVID-19 here in Europe as well. But investors have certainly taken a bit of money off the table because of all of the uncertainties and all of the risks right now.
Yeah, well, while investors are keeping their eyes on Fed, here in Nigeria, we are keeping our eyes on the Central Bank of Nigeria as they will be announcing their policy rate today. And hopefully, Chelsea, tomorrow we'll talk about Fed's decision. Enjoy the rest of the day. And China's sweeping crackdown on companies ranging from education firms to the technology sector has continued to fuel sell-off in global stock markets. The London market opened low in the morning. Let's hear more from Juliana. Hello, Juliana. Good afternoon. Well, China crackdown has continued to fuel global share sell-off. But aside from these, investors are also focusing on Fed meeting and trade data. How are all of these playing out at intraday?
Yeah, good afternoon, Chimeze. I'll pretty much be doubling down on what Chelsea has just been saying, is that in London, all eyes are across the globe, really. It started with the big sell-off on the Hang Seng Index, which has been going on for more than 24 hours now. The Beijing Authority crackdown is swift, it's ongoing, and it really is affecting the big domestic tech giants there. Many of them are selling not just in China, but they're also selling on the New York Stock Exchange as well as here in London. That has started to spook investors. And again, as Chelsea was saying, there's lots of updates expected. We had the Tesla update yesterday that beat market expectations. We're expecting something similar possibly from Apple, and then Alphabet will also be updating their earnings, as well as Microsoft. Much closer to home, we had retail sales data for the month of July coming in a lot stronger than expected, though there are some mullings about supply chain issues. We know supply chain bottlenecks has been a major cause for concern in the pandemic. That's slowly creeping in to the retail chain. And pingdemic in the pandemic is also causing lots of trouble and concern. Many people working within retail are having to sign off because they've been coming into close contact with people that are tested positive for COVID. So red is the theme colour of the day on the FTSE All-Share. It's down 0.47% at intraday. The FTSE 100 also down 0.51%. And the FTSE 250, the domestic market, down too at 0.22%. In the currencies market, the British pound is down on the US dollar also by 0.21%, down on the euro by 0.07%, and down on the Japanese yen at intraday by 0.46%, Jimmy.
All right, Juliana, we'll leave it at that. And we'll continue to monitor the Fed's decision tomorrow. And we'll talk more about that in tomorrow's program. Enjoy the rest of the day.
Thank you. Thank you.
And since monetary policy committees in some of sub-Saharan Africa's key nations last met, resurgence of coronavirus infections driven by the highly transmissible Delta variant threatens to choke off lackluster economic recoveries. Temporary restrictions on movement were imposed in Western Kenya in a bid to avoid a catastrophic fourth wave of infections. In South Africa, the reintroduction of strict lockdown measures and deadly riots emerged as key risks to economic growth. Higher oil prices may bolster economic growth in Nigeria, the continent's top crude producer, but the increased cost of imported refined fuel will also stoke consumer price growth, adding to pressures of rising food costs. And here is what Africa's major central banks, talking about South Africa, Nigeria, Kenya, and of course Ghana, have done and are expected to do as they meet this week and next for their policy rates setting. We begin with South Africa. The Reserve Bank held its policy rate on July 22 and left its key rate at a record low of 3.5%. for a sixth straight meeting as the strictest lockdown measure since May 2020 and deadly riots that disrupted activity in two key provinces dim economic recovery prospects. And the central bank's quarterly projection model, which the MPC uses as a guide, in May indicated one rate increase of 25 basis points in the second quarter and another in the fourth. It deviated from the model by leaving the benchmark unchanged at its last meeting and has softened its stance about tightening. Now let's look at Kenya. The Monetary Policy Committee, of course, is meeting tomorrow as Wednesday, July 28th, and is likely to keep its key rate unchanged for a ninth straight meeting, even as higher fuel prices threaten to stoke inflation. And economic analysts say muted demand due to pandemic restrictions, including a dusk-to-dawn curfew, mean monetary policy tools won't help in containing cost-push inflation that's being driven by higher oil prices. According to the chief economist at Nairobi's Mentoria Economics, Ken Chingaga, the virus containment measures mean the economy is operating on one engine. For him, a better bet would be to stabilize the local currency and for the government to speed up the rollout of COVID-19 vaccines. We'll see how that meeting goes tomorrow. In Ghana, the central bank, of course, on Monday, they met and they held its main interest rate at 13.5% after having cut it by 100 basis points in May. The bank's Monetary Policy Committee held the rate after determining that the risk of inflation in Ghana had broadly balanced out. Inflation in June stood at 7.8%. Inflation in Ghana has declined in recent months from 10.3% in March to 7.5% in May. Rates have, however, largely remained within the bank's targeted band of 8% plus or minus 2 percentage points. And here in Nigeria, the MPC meeting started yesterday and the decision will be announced shortly. While price data suggests inflation that is almost double the ceiling of the central bank's official target may have already peaked, policymakers have made it clear that they'll only switch to taming consumer prices after seeing solid growth momentum. Joining me now for this conversation is a development economist. Professor Ken Ife joins us from our Abuja studio. And of course, I have the head retail investment at Chapel Hill, Durham, Ayodeji Ebo. Thank you very much, gentlemen, for joining me this afternoon.
Thank you for having me.
Well, let me start off with you, Professor Ife. We have seen the emergence of a new wave of the virus and, of course, the slow rollout of COVID-19 vaccines across Africa, which means their economies remain vulnerable to a new wave of the virus. How do you think this and, of course, other external factors would shape the direction of the MPC as they conclude their meetings today?
Well, I think I'm glad you mentioned the new wave of COVID. COVID-19 has been the major cause of all the headwinds, macroeconomic headwinds we have experienced in the last 18 months. And that is what has brought us on our knees in terms of massive impact on supply chain disruption. And then, combined with insecurity situation in Nigeria, you can see why our figures are completely at variance with those of Ghana, Kenya, and South Africa. Understandable. But this third variant may cause more problems because though Nigeria is still coming up, but the aviation has been recovering and is the worst hit of all the sectors. But it is just gradually recovering, and the aviation always takes the first hit on this. And then, of course, the transportation system is also recovering, but is still responsible for much of the inflation that we have, because even though the petrol price has not gone up, the subsidy is keeping it down. But there's also other costs of transportation because of this security. Transport that would have taken 1 day is now taking 3 days, so it multiplies the cost. So all of these will come to bear, and I can see that if we don't tighten up on our COVID-19 prevention mechanisms, then it could potentially do more damage than we would have expected now. You could look at America. Over 99% of the new deaths are because of people who have not had the injection. And we have very low intake of these injections, so we will be open to that attack. All the hospitalization figures, everything is over 90% in America. And it's all arising from people who have not taken the vaccination, and then a lot of them, the new COVID variant, the Delta variant. So we'll keep our fingers crossed.
Right. Okay, Ayodeji, let me ask you now, what do you think the central bank will do, considering money supply, the marginal dip in the rate of inflation, the sluggish GDP growth rate, and of course the declining external reserves, although we saw that external reserves inched up a little bit. That was the last figure posted, but still relatively on the declining path.
Okay, thanks. I think just a bit of background, because what this MPC will look at is to see the developments within the last 3 months when the last MPC held. And when you look at some of the factors that you mentioned, inflation rate in the last 3 months has been moderating in the last 3 months, currently at 17.7%. You also look at the external reserves have still been above around the $35 billion level. Oil price is still really very high. You spoke about the money supply. I believe that would have also increased because of business activities. So and when you look at the growth level, though we've not seen the GDP for the second quarter, but we know on a base effect basis, that will still be positive and will be a strong growth. So on the back of that, the CBN we believe that CBN will decide to hold the major rates. We're talking about the monetary policy rate, the liquidity ratio, as well as the cash reserve ratio. CBN will hold and to watch because we believe that some of the intervention funds are are beginning to yield results, and they won't want to raise rates for them to unwind some of those successes that it has achieved. And also bringing down rates at this current level now will increase money supply in the system and may further fuel inflation, which has been on the downward trend. So what we are projecting and we're expecting is that CBN will maintain status quo, and for them to see that a lot of the intervention funds that are being put in place, but they would also like to emphasize that government will need to accelerate the implementation of policies to sustain this positive trajectory.
All right. Thank you very much, Ayo. Just hold your thoughts there. We'll take a quick break and we'll be back in a moment. If you've just joined us, you're watching special edition of Business Incorporated, and we're looking at the Monetary Policy Committee meetings decision, both in the past and hopefully what they will come out with after their meetings today. And I still have with me Ayodeji Abel, the head retail investment at Chapel Hill, Durham, and of course Professor Ken Ife, who is a development economist. Prof, let me start off with you now. Well, you did reel out some of the challenges the country, of course, is facing now. Globally, yes, we're talking about COVID-19 and of course the new variant that is coming out now. You did mention security issues. Ayodeji is saying that, of course, he expects the central bank to maintain status quo. Now, considering, central banks all over the world always facing a monetary policy dilemma, do you think there will be any trade-offs between any of these considerations? We did talk about money supply, we did talk about the marginal dip in the rate of inflation, and of course we talked about the sluggish GDP growth rate and the decline in external reserve. Any trade-offs?
See, let's take it one by one. Those three monetary policy parameters. The MPI rate, I will be surprised if they change the MPI rate, either going up or going down. The reason is I'm happy for them to fine-tune the asymmetric corridors, to any degree they wanted. But that rate, I should think, should stay there. The reason being that, one, we have stagflation, which is an unusual kind of recession. And we just came out of it. But not completely, because you don't know. After the manufacturing index is a bit low, the last one that was announced. So we're not out of the woods yet, even though we just sustained small growth. Secondly, the inflation has trended a little bit steady. So, but these things are not safe. They are very, very small margins. So if you go and push the rate now, okay, most central banks around the world are looking at end of this year to begin normalization of monetary policy. And I don't think we should veer out of that. Let's keep up a little bit, because don't forget that last year we had, quantitative easing, we had the quantitative fiscal and monetary policy intervention. We delivered almost 300 billion naira to households and MSMEs. So a lot of money has gone out to make sure that we fight that recession, and we fought it to a standstill and got out within a quarter. So, and then you also had the statutory forbearance on the banks to restructure loans and then lower the rate from 9% to 5%. Fine. But these will have to temper somewhere towards the end of the year. But meanwhile, the CBN can use other instruments at its disposal, which is the open market operation, to begin to mop up liquidity, so that we can still show that we are sensitive to the issue of money supply, which are always touted by some of the people that the money supply is at the heart of the inflation, even though I don't agree with it, but it does contribute. But the extent to which that dictates what is going on in inflation today in Nigeria is suspect. But be it as it may, so they're beginning to do that. And then also CBN is out there in the market, and the federal government is out there in the market, bond market and the treasury bill market, beginning to sell. So all of them are withdrawing and restraining liquidity. So we are still achieving that effect without going to tinker with a headline rate that will cause, we don't know where it's going to. That sleeping dog should be allowed to lie, at least for now. Then you come down to liquidity ratio, we're okay. Because if you look at the latest figures, our liquidity ratio, we're actually, of the average, is over 32, is about 32 point something percent. So we're over 30%. So the banks are doing really well on those. Then you look at the cash reserve ratio, there's no challenge, is substantially high at 27.5. Bear in mind that the loan to the deposit ratio has been increased from 55 to 60 to 65. And not all the banks have met that. So it's still out there. So when you add 22.7 to 65 and all of that, you see that we're actually squeezing the banks and then making sure we redirect their lending to the private sector. Of course, also, the differentiated cash reserve ratio is also doing the same, which is encouraging them to take those cash reserves that are not earning them any income and then lend them at those conditions, 7 years and all of that. So all of those, the banks are actually doing well. If you look at the non-performing loans, the prudential guideline is 5%. At the moment, they are closing down to that 5%. It's only about 6 point something percent. They're very close. And then, so and then capital adequacy ratio, they're doing really well in that because it's 15, but their ratio is well over 15% on the average. So the banks are actually healthy. And that is because of the measures taken last year. And so when you have all these things, you have to take it easy with them because the security situation hasn't improved substantially to give us that comfort that the investors will continue to come back. A lot of the investors left in the second quarter of last year, especially portfolio investors. And because they left, then it created far more problem on Forex side of things. And there were others, the speculation is very high. With the higher the inflation, the higher the speculative activity around the Forex. So, and then you see the insecurity as well. With insecurity is also making people head out to buy currency because they are now safer. They feel they are safer holding on to dollar than holding on to naira. And there's also increased dollarization of Nigerian economy. So all of those are putting pressure on our Forex. And remember, in inflation, you look at two things, structural factors which we know are dominant. The agro situation, the security situation, the manufacturing, all of those are dominant. Then you have the money supply side, which are domestic and foreign. The domestic one I have just talked about and what government is and what CBN is doing to mop up liquidity. Then on the Forex side, which is a Forex supply, then we have issues. We don't have any control on that. It depends on what OPEC allocates to us, what we're able to produce, and what the price is. And even as things are right now, we are not getting all the money that we should have on Forex. We are not getting all the diaspora remittance. We are not getting all the money in the benchmark. We are getting substantial headroom on the benchmark from $72 to wherever it was. And we're not having that head into the excess crude account or any more accretion to the reserves as a result of that. So there are things going on that we don't have much control. But
putting so much pressure on the foreign exchange market. All right, Prof. Now, Ayodeji, I'm sure you listened to Prof. How would you react to his position to this? Well, talking about the CRR, of course, the banks have often complained that the frequent CRR debit has been impacting on their ability to plan and also increase lending. And some also believe that this is another move to curtail demand for FX. What's your view?
Okay, thanks. I think when we look at, Prof well said that it's around the 27.5%, but when you look at the effective CRR, some banks are as high as 70–80%. based on the effective CRR, which is based on the frequent CRR debits that most of the banks receive. So yes, I think what has brought about the issue of maybe with the perception that the CBN is trying to prevent the demand for dollars, trying to prevent that, is because most time it comes like a day before it comes like a day before the auction, the FX auction. So and that's me, and that has based on that intonation, most traders or most investors have come to that conclusion. Also, but if we look at in terms of how the CBN can also use the CRR to control money supply, and that's why for most of analysts, we're expecting that there are other tools beyond even the OMO instruments that the CBN can use to control money supply in the system. So when you check the interbank rates since the beginning of this year, it's been at double digits, and that is what is responsible for the high deposit rates that we're seeing in most banks at double digits level. So we expect that that would impact on the cost of funds for most of the banks. Coming from last year, that was almost near zero, and this year it has remained at high double digits levels. It got as high as almost 30% at a point in time. So we believe that, yes, we're based on your question on the CRR level. The CRR is controlling money supply in the system, and we believe that CBN will continue to use that instrument to control money supply. But we also believe that if for us to also balancing between growth and inflation, there may be need to adjust the CRR. So now, beyond the 27.5% statutory CRR, looking at the effective CRR, there may be need to adjust that to increase money supply in the system such that banks can have more to lend. Yes, it may fuel inflation, but we have other critical factors that are impacting on inflation than money supply. The Prof also mentioned some of them. The insecurity issue is still there. That's the major issue that's reducing production. And if we don't tackle that, I don't think money supply would solve the problem.
All right, thank you very much, Ayodeji. Well, at this point, we'll leave it for now for Business Incorporated. Well, on this note, we draw the curtain on this special edition of Business Incorporated. Of course, the Central Bank Governor will be addressing the press and running out the communique of this MPC meeting in about 15 minutes' time from now. So do join us at that time. Thank you for watching. I'm Chimeze Obi Iwago.